So I want to buy a home. How do I qualify? Well, by the end of this video, we're going to go through three main things that will help answer that question: income, assets, and a credit report. Hi guys, welcome back to the channel. My name is Gavin Sessions with Loans Made Simple. I help people in all 50 states with home loan financing. If that's something you're interested in, subscribe to the channel. I post new content each week. So when you're qualifying for a loan, the three things we're going to really look at most are going to be your income, and that's where you make your money. Assets, think savings account. It's money that you've saved that can be spent in a real estate transaction. A credit report, which gives us a list of your liabilities, as well as a credit score, which is a performance metric on your payment history. All right, so number one is going to be income, and that's very simply, how do you make money? You might be a W-2 employee, you might be self-employed, but basically what we want to confirm is that you have a regular income stream. And what an underwriter cares about most of all is that your income is stable and continuous. The way that we're going to look at income most of the time is going to be on pay stubs, and what we're going to look for is 30 days worth of pay stubs, and we're looking for consistency. Let's say that you're a W-2 employee that earns an hourly wage. We're going to look at your hourly rate of pay. We're going to multiply that by the hours per week that you work. We're going to multiply that by the 52 weeks in a year, and then we'll divide that full number by 12. That gives us your gross monthly income. In a mortgage transaction, we actually qualify you off your gross rather than your net. Why that's important is it actually gives us a little bit more income to work with when we're calculating your debt to income ratio. All right, so what if you're not an hourly employee? What if you earn a salary? Well, we love salaried employees, and underwriters love them even more because your income is consistent from month to month. So salary means you earn X amount of dollars over a given year. And when you divide that by 12, it's going to be the same for each month. Let's jump into another example. Maybe you earn commission. Maybe you're a salesperson. Maybe you sell cars, and your income actually fluctuates from month to month because maybe you're going to have a month where you sell more cars one month in June, and then maybe in July you actually sell less. How do we would calculate your income then? We would actually look at a 2-year history where we'd take your total income for 2 years and divide that by 24 months. So let's say you're not an hourly employee, you're not a salaried employee, you don't earn commission, but maybe you're a self-employed person. Well, the way that we calculate your income as a self-employed person is looking at your tax returns for the past 2 years. Now, the other key difference, or one other key difference I should say about being self-employed, is we actually look at your net income versus your gross income. And that's important because as a self-employed person, you have the ability to write off your expenses. So to calculate your income as a self-employed person, we simply look at your last 2 years of taxes, we subtract your expenses, we add those two net bottom lines together, and we would divide that over by 24 months. Ultimately, our team is here to help, and we would be happy to look into your specific situation. My contact information is below. Reach out, and we're happy to make sense of all that for you. Right now, your mind is probably spinning on a bunch of different questions that we may not have hit on. Maybe you have 2 jobs. Maybe you haven't had the same job for the past 2 years. Maybe you've been a student and don't have 2 years of employment history. All of that is okay. We would love to just start and have a conversation and help you make sense of your income so we can help put a plan in place for you to be able to buy a home. All right, moving on to the next thing, we want to talk about assets, and this is money in the bank. This is probably not an RV. It's probably not a boat. What we're most interested to understand here is liquid assets. In other words, money that you could bring into a transaction to cover your down payment or to cover your earnest money or to cover your closing costs. It is liquid assets. So most simply, it would be a savings account, right? Or maybe somebody has a money market account. Maybe somebody has a 401k or a retirement account. Those could all work. Those are accounts where balance could be liquidated and could be brought into a transaction. Now, for clarity, I'm not telling you to liquidate your retirement, but they are assets that could be used in this scenario. One really important thing about assets that I want you to be aware of is money that is saved in a safe in a home, or what we would call mattress money, or money that might be in a coffee can in a closet or a cupboard somewhere. Those funds are actually not eligible to be used in a real estate transaction, and that's because of something called seasoning. So in order to use assets in a real estate transaction, they must be deposited into a bank account, and they must season in that bank account for 60 days. So the best rule of thumb is basically if you make a deposit today, we need to see 2 bank statements before those funds would be eligible to be used in a real estate transaction. And you may ask me, why is that? Well, there are anti-money laundering laws that prevent assets from being used in a real estate transaction until they've been seasoned for at least 60 days. Now let's talk about gifts. And I'm not talking about the kind that show up under the tree, but rather a gift from a family member that could help cover your down payment or your closing costs. Now, if we just talked about seasoning, which is where money has to sit in a bank account for at least 60 days. The cool thing about a gift is it actually doesn't. So if you had a mom or dad that wanted to help you with a down payment, they could give you a gift. It's best if that gift was sent directly to the title company, but they could deposit it into your bank account. The way we get around the 60-day seasoning is with a signed gift letter by all parties on the transaction. So the donor signs and then the recipient signs. That gift letter then helps us avoid a 60-day seasoning. Last but certainly not least, we want to talk about credit reports and why they matter. So you might ask me, why do I need to see your credit report? Well, it shows us two things. Number one, it shows us a comprehensive list of your liabilities and their minimum monthly payments. And number two is your credit score, and that it does not need to be scary. It's simply your report card of your payment history over time. The higher the score, the better the payment history. The lower the score, generally, the worse the payment history. Now, other things can affect your credit score as well. Let's jump back into the minimum monthly payments and why that matters. So we have to think about something called a debt to income ratio. So if we go back to our income conversation, W-2 employees, we're going to use their gross monthly income. Self-employed people, we're going to use their net monthly income. What we're going to do is take the total of your recurring liabilities on your credit report, and we're going to divide that into your income. And that gives us a percentage. Generally speaking, we want to have a debt to income ratio of about 45 to 50% at the most. So thinking about debt to income ratios further, what we would do then is take the monthly income number that we've already calculated, and we'd multiply it by 45 to 50%. For the sake of this video, let's say 50%. And that gives us an amount. From that amount, we would then subtract your total monthly recurring liabilities on your credit report. Ultimately, your debt to income ratio helps us understand the total amount of recurring monthly payments you can have, including your mortgage payment. So we've covered income, assets, and a credit report. And our next step would be to wrap those into a loan application. And from there, we would determine what your purchasing power is. And that's how you qualify for a home loan. Thanks so much for watching. Please leave your comments below. I'd love to understand what questions you have. If you're looking for a home loan, please reach out to me. We help people in all 50 states. We will see you on the next video.